Hello everybody, it's January 25th, 2025. We're going to look at where we are in this topping out cycle right now for the stock market. Um, so we have been over the uninversion of the yield curve, right? If you don't know what I'm talking about, go back, look at the two previous videos that I did on this. The 10-year, 2-year rate uninverted right here. And now, as an update, the 10-year, 3-month rate has uninverted as well, right there in December. So what this means is right here was the line I drew January 21st or so. That is the beginning of the end, right? The anywhere in this region from January 21st to like April 7th. Now that's an estimate based on previous uninversions, but basically anywhere in there, we can see a topping out of the stock market followed by the beginning of a crash. I'm not saying it goes straight down, but that's just where it's going to top out, somewhere in this region. So we are there, we're there now in the danger zone. Anywhere in here, I do expect it to go a little bit higher still, but anywhere in here should be the top. Now, let me show you a little bit more evidence of that if we zoom out. If we look at this from an Elliott wave, oops, sorry there. We look at this from an Elliott wave perspective, and we look at the Dow Jones chart going all the way back to 1897. You can see right here, we have a wave one, right? The first move up. We have a big crash. There's the Great Depression right there. Okay, so that begins our 1-2. Now markets move in 5 wave impulses upwards when they're bullish, or they can move 5 waves down too. But you know, if we're bullish, we're moving in 5 waves, right? So this entire stretch from the end of the Great Depression, literally to where we are right now, is all likely a gigantic third wave. Within that third wave, we have 5 smaller waves making it up, okay, which lends even stronger credibility to this theory. Because within each of these, Elliott wave is fractal. Within each larger wave, you're supposed to have 5 waves within that, okay? So right there, you can see we've got 5 waves, and the target for this, based on this wave 3, the length of this wave 3 from 2 to 3, the target is right here. Anywhere between 45,500 to 97,000 is the target for this 5th wave of this larger wave 3. So you can see we are just about touching it. We've got about 1,000 points more on the Dow to potentially get there and finish off this move. Doesn't have to finish at the bottom of this box. Literally anywhere in this box it can finish. So it could, you know, things go crazy, it could go all the way to the top of that box. I'm not saying it's not going to. It seems unlikely right now. You know, most likely we spike sort of lower end of that box before coming down. But then here is the bad news. After this is done, once we hit the top, we are going into wave 4. That wave 4 macro target is down here between 3,000 and 11,000 on the Dow, based on current, you know, we can revise that once we actually have a top. But generally that's going to be the target, somewhere in that 3 to 11,000 region. Okay. So that is scary, right? Because if it dropped right now, at a minimum, that's a 75% drop. At a maximum, you know, potentially 90% plus to hit that target box. Okay, so we're talking gigantic loss of value on the Dow here. The other thing we need to talk about is what's called the theory of alternation in Elliott wave. This right here, move down during the Great Depression, was essentially straight down, right? I mean, if you look at that, that's just a giant crash downwards, okay, without much relief at all. Yes, it took a few years, yeah, right? So, because this is a monthly chart, that's from 1929 to 1932, essentially. 3 years of essential straight down. All right. Now, what alternation says is that usually when you have a wave 2 like this, a straight down wave 2, you're typically going to have a more stretched out, prolonged wave 4. So, good news, bad news, I suppose. Essentially, what that means is, we're not necessarily going to have a 90% straight drop over the next 2 to 3 years. Instead, we're likely to have something kind of meandering and downwards over the next 10 to 20 years. Maybe more, who knows? Okay, for however long it needs to take place, we are likely going to have a lost decade or two potentially coming down to this fourth wave, right? Doesn't mean we're not going to have bull markets along the way. We come down, maybe we have a little bull market here, right? We always have bull market rallies, but what it does mean is we're very unlikely to see a new high for the next, I'm guessing, 10 to 20 years once this tops out. So that's the bad news there. So I don't know if you can consider that good news that it's not going to be straight down, but let's see the silver lining and say, it's going to be a little bit slower, a little bit more drawn out potentially. But it means that, as a long-term prospect, the stock market is not going to be the place to be, in my opinion, based on these charts, based on the uninversion. Stock market is not going to return the way that it has done previously, right? And if you were, it looks small looking on this monthly chart, this period right here, okay? But this is essentially, you've got your dot-com crash is right there, and you've got your 2008 financial crisis right there, okay? But essentially this entire thing was corrective, right? And we're going to see a larger version of that, okay? So if you remember that decade between 2000 and 2008, 2009, kind of considered a lost decade because it really, the stock market made a very brief new high there before it crashed, but really did not give the returns that people were used to over the previous decade. That was the previous decade right there, straight up, right? And we've seen that consistently through the stock market basically since the Great Depression. It's consistently been up. It's been the place to be, right? Your retirement account is safe, if you're going up like that. Your retirement account does not look safe, does not look good when you're doing that. So take that with a grain of salt. Do with it what you will. I'm not giving financial advice here, but for me, stock market is not going to be the place to be over the next couple of decades here. So yeah, anyway, cash is going to be king. Waiting for opportunities is going to be a good thing to do. Having cash on hand in order to buy, potentially, and take advantage of some of those bear market rallies that we're going to have along the way. But I'm certainly not going to be long-term holding anything during this next period because it's just asking for trouble, in my opinion. All right, hopefully that is helpful for you guys. I will try to do another update, when I believe the top is actually in, once we have some confirmation of that. Fair warning, though, that's likely to involve kind of a mini crash before we have that confirmation. We're probably coming up here and then mini crash, that might be your confirmation, and then we'll want to get the heck out of everything. Certainly, if you haven't already, then certainly on that next bounce would be my my plan anyway. All right, guys, take a look at the other videos I've done on this, like I said, so you have a little bit of context on why that uninversion is so important. And I will talk to you all again when we have some confirmation.